standout, at least from the report card for DBS. Net interest margins hitting about 212 basis points for the first quarter. But you did say earlier on that there is a possibility that this is likely peaked at this particular time and could ease gradually. Just how much of an easing are you expecting for net interest margins for DBS? And is this as good as it gets for this particular thing that we've called the NIM party before?
Well, JP, we did give guidance that we think NIM probably peaked around these levels. Our NIMs for Feb, March, April have all been in the 210 to 212 range. And as best as we can forecast, we don't see too much more upside from the NIM line. However, as you mentioned, I think the pace of decline will also be very gradual. Like I said, it's been flattish. We're still guiding for a full year average of between 205 and 210. And our year-end NIM is still likely to be north of 2%. So I do think you'll see some gradual slowdown. It's not going to fall off a cliff. Your underlying question of, so where does growth come from? Interestingly, we are still continuing to see healthy business momentum. Despite, notwithstanding the slowdown in the West, by and large, Asia is being quite robust. We expect China to grow 4.5% plus this year. We think Hong Kong will come in about 4%. India at like close to 6, Indonesia at 5. So by and large, we think the region will continue to be quite robust. And frankly, even the West, 2 quarters ago, everybody was fairly sure there would be a recession. And now the jury is out whether they might actually escape a recession. So we think while there is slowdown, it's again not going to be calamitous on the one hand. I think the fundamentals that we've always believed in Asia continue to work. The demographics are good, infrastructure spending is going on, trade and intra-Asia trade continues to be robust, wealth management continues to be very strong. So we think some of these drivers are still in place, and that should help us continue to build business quite decently going forward.
Mr. Gupta, can you share with us your outlook now for loan growth, which I believe is also expected to moderate, moderate. What areas are you specific? Are there particular regions or areas that, where you're expecting loan growth to be propped up in case there is a slowdown in some of your other key markets, for instance?
The bulk of our loan growth comes from the large corporate book, and that is very stable. It's robust. We got $4 billion of growth in the first quarter, and our pipelines in that part of our business continue to be quite strong. The couple of areas of uncertainty, one is in the trade finance book. That always tends to be a little bit opportunistic. What's happening in recent times is because onshore rates in China have dropped, many of our clients are finding it easier and more efficient to switch from offshore financing to onshore financing. And so that creates some challenges for us. I think there might be some little bit of slowdown in the mortgage book in Singapore. It has started recovering quite nicely after the tightening of the fourth quarter. In fact, our bookings in March were back to normal. But the latest round of tightening means that we might see a little bit, a few $100 million, maybe $1 billion of slowdown in that category. And the third category is wealth management. We do a lot of margin financing or term loans against wealth management. What's happening now is that people are cashed up, and so they're putting their own money to work and taking less leverage from the bank, especially at these interest rates. So that's proving to be a little bit slower than we were hoping for. But like I said, we put all of that together. We still think that we can get 3 to 5% loan growth for this year. And given the overall market conditions, that's not too bad.